Hello friends, welcome. I hope you are doing well. Today we are going to talk about basic accounting concept. Accounting concept refers to the rules of counting which are to be followed while recording business transaction and preparing financial statement. They are the basic accounting assumption. They act as the foundation for formulating the accounting principle, methods and procedure. In other words, they guide the preparation of financial statement. Business entity concept. According to this concept, all the business transactions must be viewed from the perspective of the firm, not the owner of the firm. It is because of this concept the capital provided by the owner are regarded as the liability and the profit is also treated as the same as they are payable to the owner. As such, the drawing made by the owner for the personal use are treated as assets or subtracted from the capital as they are recoverable from them. This concept enables a business firm to determine the operating profit or loss correctly as the transaction between the owner and the business are recorded properly. Next one we have is monetary concept. This concept is based on the notion that accounting should record the information and event of the business enterprise which can be expressed in monetary terms. In other words, the business event and misinformation that cannot be expressed in monetary terms are out of the scope of accounting record irrespective of their relevance and importance. Going concept, going concern concept. This concept assumes that a business entity is a going concern. In other words, the business is conducted for an indefinite period of time. This concept is the reason of not keeping the assets at the value at which they are sold in the market, rather considering their likely contribution in the coming period by their use. Next one we have is cost concept. This concept is very close to the going concept and based on the principle that assets or resources owned by the firm should be shown at the cost of their acquisition, not at their current market or sale value. For example, fixed assets are shown on the balance sheet at the price paid to acquire them, their historical cost less depreciation written off to date. The market valuation is not required for long-term assets as they are not acquired for sale but to be used in the business for long period of time. For example, the land purchased by a business 3 years back at a cost of 2000 should be shown at the same amount even today despite the increase or decrease in price. The principle leads to distortion of the true worth of assets by sticking to its original cost. Dual aspect concept. The dual aspect concept states that every business transaction requires a recording in two different accounting period concept or that the accounting must follow a certain period of time so as to enable the presentation of the result of the business operation, say profit on or loss suffering during the period under review. Realization concept. According to this concept, revenue should be considered as being earned on the date when goods are sold or services are rendered to customer. Accrual concept states that income and expenses are recorded as they occur regardless of whether or not cash in hand has actually changed. Matching concept. This principle is based on the notion that expenses recognized in an accounting period are matched with the revenue recognized in that period.